into negative news flow.
All right, Steve Brice is now joining us, Chief Investment Officer at Standard Chartered Wealth Management. Steve, good to have you with us here. Thank you very much for your time. What are the next cues to watch out for? Because this week has started on a much better note. No fresh headlines of bank/financial sector pain. Are markets settling down?
Certainly, I seem to be getting a bit more sleep these days, which is a very pleasant development. Yeah, so things do seem to be calming down somewhat. I think, if you obviously on the banking sector side, the Credit Suisse situation has calmed down in the US as well. We've seen some positive development. So from that perspective, this sort of risk of systemic crisis coming from the banking sector does seem to have diminished considerably in the past week or so. Obviously, still things can happen. I mean, we still have the situation in the commercial real estate market, particularly in the office space, that can still feed into the regional banks. But at least for now, we do seem to be getting a bit of a hiatus, which is good. I think longer term, though, we still feel that we are heading towards a recession in the US. So from that perspective, we still feel that that's something that's going to be a very significant headwind for risk assets later in the year. The question is, do we get a melt-up scenario in the short term before that happens? But ultimately, we do think we're going to make new lows for the S&P.
Okay, so you're saying we're heading towards a recession for sure in the US, and we're going to make new lows in the S&P 500. But Steve, just to play the devil's advocate here, one narrative is that a lot of the recessionary news, the layoffs, the slower growth has been priced into most global markets, and hence we haven't seen too much of an impact, especially in a market like India, which has shown a lot of resilience. Is that your view as well, that even if we do head into a full-blown recession, a lot of the damage has already been done in equity markets?
So I guess some of it has been done. Obviously, equity markets are still far from their peaks. So you can argue that some of it's priced. I think what we would say to that is you've never seen equity markets trough before a recession has started. So from that perspective, we believe that markets are not excessively cheap. They're not nothing like as expensive as they used to be, obviously, but they're not cheap. So that we can still see, at least in the global market context, we could still see some significant weakness coming through, once it becomes clear that we are in recession, and that earnings, still people are looking for a fairly placid earnings outlook in the US market, and we think that could be revised significantly lower going forward, and that will be a headwind, obviously, for stocks. Now, the question is, obviously, then at some point the Fed will pivot, and then that can lead to the growth versus value conversation, which could be positive on a relative basis for US stocks. But we still think we've yet to go through that first earnings downgrade to get to that point.
All right. Hi, Steve. Good morning. Steve, the point you made on the US equities, they could retest lows that we saw last year. So on the S&P 500, another 10 to 12% correction. Is that something that you're working with?
It could be slightly more, So I think one of the questions that we all have is, okay, I think recession is becoming increasingly a consensus call, and if anything, I think the indicators more recently are pointing to a higher probability rather than a smaller probability. So we're around a 3/4 probability that we'll see a recession in the next 12 months. But I think the question then becomes, okay, how severe will it be? Our sense is this won't just be a run-of-the-mill recession. It may be slightly worse just due to the pace of the tightening that we've seen in the US and the lagged effect of that monetary policy tightening. Obviously, what we've seen in the regional banks doesn't help either. And we believe that the Fed is going to be reluctant to pivot. So a lot of the analysis that we do on when the Fed will pivot towards cutting rates is based on history, and usually history post-1980. The point we would make is that obviously this is a very different environment where inflation is still a challenge. So from that perspective, it might be more than neutral.
All right, Steve, what about the Indian markets? You were leaning towards the Chinese markets the last time we chatted. Indian markets, well, we've been relative underperformers just in the recent past. Now, what's the toss-up between India and China? If things are going to get a little bit jittery globally, will you go for the market that is offering earnings growth, though is relatively more expensive, or will you stick to China?
So at the moment, we're sticking to China. So from our perspective, obviously, I mean, I think the news from Alibaba, I actually read as a significant positive. I mean, one of the things that we struggle with when we look at different sectors, for instance, in China, is the predominance of, Alibaba in the consumer discretionary space. It's around a third of that index, or Tencent is almost 3/4 of the communication services. So if we do see smaller entities coming through, that will deepen the market, in our opinion, and make it more investable. But obviously, the main factors for us is that we see the fundamental drivers post reopening as being very positive for the Chinese market. Valuations are much less stretched. It doesn't. Again, we've had this conversation before. It doesn't mean we're bearish on India. We do believe that India will do well, but we do prefer China at this point in time.
Okay, so you're not bearish on the Indian markets. You think India will do well, but China is your preferred market. Got that. Finally, Steve, before we let you go, is equity still a good asset class to be in for the rest of the year? Or are you changing your stance on that as well? Are you raising your allocation towards debt, towards gold, alternate asset classes? What are you looking at?
So we've been underweight equities through the first quarter. So we're retaining that view. We believe that that global recession or US recessionary market is going to be a significant headwind, particularly for developed market equities. So we retain underweight, and that's why we have a bearish call there as well. We believe that we should be in high investment grade bonds. Particularly in Asia again, given the positive fundamentals. But we're pretty defensively set up, and we retain that for now.
All right, Steve, it's a pleasure as always. Thank you very much for joining in. And important points that once again markets seem to be sort of underpricing what the Fed will do. But they quickly price things back, don't they? The 2 years back at 4%. After the steep sell-off that we saw amidst the banking crisis last week.